We are live. What's up, everybody? Welcome to Own the Chaos. My name is Brad. The stock market is crazy and chaotic, and I made it my mission to help you guys own it. It's been a crazy weekend, right? I mean, cryptocurrency, we saw Bitcoin drop all the way down to 17,000 and some change. Been absolutely wild, but we also have a very important guest today. Joseph Hogue is behind the scenes right now. I'll bring him up in just a second, but I wanted to kind of cover some things that are going on in the market right now. Unbelievable bounce back, right? I mean, we saw Bitcoin bounce or get sold off kind of like in a capitulatory fashion all the way down to 17,500 and some change, which was pretty crazy. And then it bounced all the way back up to 21,000 and some change. So an unbelievable move there. But we're also seeing some moves in the indexes as well. We have the S&P 500 sitting at 3774. That's good for 2.71%. Unbelievable bounce there. The Dow's also up 2.25. NASDAQ's up 290 points or 2.69%. And believe it or not, it's off. All three of the indexes are off their highs. And then WTI crude is also back up to 110. That was down to around 109 or so as is the close on Friday. So pretty crazy bounce back. And that's kind of what I'm bringing Joseph Hogue on today for. We're going to be talking a little bit about this potential bounce back. Could we see a bottom? He's going to bring some really interesting data for you from the last recession. We're going to talk about whether or not there are stocks that are recession proof or recession resistance, maybe kind of delineate what the difference is between the two and then go from there. But before we get into anything, guys, as always, you all know that I like to give my starting five a nice little shout out. What's up, Tiger's Edge, Lick of John, Savvy Money Show, Fernando Pereira, Lindsay Heiss, and we'll throw Jeff Chocolate in there as well. What's up, man? If you guys didn't make the starting five, it could be because you aren't subscribed to the channel. Make sure you hit that subscribe button, hit that notification bell, and would love to have you guys here. I go live Monday through Thursday at 3:45 p.m. Eastern time every single day of the week. Well, Monday through Thursday, rather. And so if you guys want to get more videos like this, make sure you leave some comments and what you think my next guest should be. I got another one coming on. If you guys recall, last week we talked about Allie Ray. She was a OnlyFans model, right? And we talked about how she was talking to the New York Post about, that they were seeing a significant drop off in subscribers. And she thought a couple of things in that article were misrepresentative of her. So she wanted to come on and talk about that a little bit, also talk about her own business. It's actually a fantastic interview, something that you probably haven't seen before from somebody like Allie. So I'm really pumped for that. So make sure you're sticking around for that as well. But also, if you are watching right now and you're visiting for the first time, anytime earnings season comes around as well, my bread and butter here on the channel for the most part is to give live reactions to those earnings. So make sure you subscribe as well on as far as that's concerned. We'd love to have you guys back here for earnings season 2. And let's go ahead and just bring on Joseph Hogue, and we'll get to talking a little bit about some stocks and what we're seeing in the stock market right now. What's going on, Joseph?
Brad, how are you doing, man? Gotta say, feeling completely inadequate after that run up on your OnlyFans interview. Not sure how many of your viewers actually just tuned out and said, "Okay, I'm back for that," but this one not so much. But no, thanks for having me on.
Absolutely, man. Listen, I got to say that, just from a creative standpoint, I certainly look up to you and your channel. If you guys aren't familiar with Joseph Hogue, the links are in the description. Go check him out. He gives all kinds of great information. And bro, I just want to say thanks for giving your time and coming on.
Cool. Awesome. My pleasure.
All right. So, as the title says, we've talked about this on the channel a little bit previously. So just to kind of tie you in, a lot of people in my community have been asking about, what should I be investing right now? What's going on with the market? I mean, I've done my best to try to kind of talk about how speculative stocks right now just aren't to play. Anything with a high multiple and especially no earnings to speak of are usually ones to stay away from during this type of environment. But you had mentioned before we came on air that you had some really good statistics on what we saw back in the 2008-2009 recession and what we're kind of seeing right now. So I wanted you to kind of expand on that a little bit.
Sure. Well, I think if investors are looking for recession proof stocks, it's going to be kind of a hard road to go. All right, because all stocks tied to the stock market, tied to that uncertainty and investor sentiment, they're probably going to fall in a recession, right? As that investor sentiment just basically sells out of everything. So there are now, there are recession resistant stocks and themes that you can go for. There's also balancing ways to balance your portfolio where you're investing in some stocks that might go up, as the market goes down. So ways to balance that, as well as just assets, assets that are going to be more recession resistant. So, kind of an idea of looking for different themes that are going to do well, even if we do get a recession, or if the rest of the stock market doesn't do quite as well. But yeah, even real estate stocks, right? Those REITs that pay out really good dividend yields. We tend to think of real estate as a diversifier, as something that is going to take a little bit of risk off of your portfolio. But even those stocks, those real estate stocks, so they are in the stock market, they own real estate directly, those companies, those even fall, as the stock market falls. So not necessarily completely protected from a recession. But, we can look at that data, some really interesting, data as far as when the stock market just crashed 55%, right? S&P 500 from October 2007 through March 9th of 2009, the bottom there was down 55%. And we actually did see 8 stocks in the S&P 500 post positive returns. A bunch of them posted, losses of less than that 55%. So there was some idea of recession resistance and, protecting at least some of your money.
Yeah. I mean, I think that it's important to understand that, maybe some of the stocks that you guys are holding are down on the year, but maybe they're not down 20%, right? Like the S&P 500 is. I think that's gets lost on people sometimes, that you don't always have to be green every single year that you're in, you're a stock that you actually believe in, like an Apple, for example, or Amazon, what have you. People, the popular ones that people have their money into. That they might have a down year, but it may not be as bad as like the overall indexes, such as the Qs right now. I mean, the Nasdaq's down with 32% before today. So I mean, it's just it is important to kind of keep that in mind, and that sometimes it might seem bad, but it could be worse, I guess.
Sure. And even the stocks that are underperforming. So you brought up Apple, a great example actually, because Apple, I think it is down something like 32%. So underperforming the broader S&P 500, but it's still undeniably a great company, right? Apple has something like $52 billion on the balance sheet in just cash and investments alone. Very strong brand name, strong business model. So, don't think that just because your stocks are down, or even down more than the market, that they are bad companies. Like I said, investors just love to sell out of everything in a stock market crash, selling throwing the baby out with the bathwater, as they say. Yep. And good companies can be down. So, reevaluate your companies, and they could still be long-term holds, even if they're down.
Yeah, I haven't done much of anything as far as trading activity is concerned, really, for the first half of this year. I'm not quite sure if you've made any kind of changes or shifts, and you can speak to those if you'd like. But I think for right now, I'm just kind of like sitting in this holding pattern, and I may not catch the bottom, but I think that catching it lower than where we were up in January 3rd, I believe, was the high of the S&P. So like if anything below that, I think I'll be happy with, but I also don't want to be too early, I guess. And they always say not to time the market, but it kind of seems to me that I'd much rather wait till we see some real solid turnaround before I feel comfortable putting any more money in.
Yeah. I've been using these bear market rallies, right? We've gotten 3 bear market rallies already this year. Yeah. Probably going to be getting more. Anytime that the market starts going up, people think that the bear market is over. Next bull market is on, and they're ready to invest, ready to buy that dip. Yeah. And we do get 5-10%. I think the one in March was actually up 16% on the NASDAQ before it started coming down. But you got to ask yourself, has anything changed, right? We are still very early in this rate hike cycle by the Fed. Inflation has not come down any. So nothing really fundamentally has changed that is driving this market lower. So you really got to be cautious about these bear market rallies, even to the point of using them as an opportunity. Stocks go up 10% or so. You make some of that money back that you lost, and kind of taking the positions off a little bit to build up cash for what could be to come.
Yeah, and I guess I try to think about like what that would look like for the average investor, right? So if you see a bear market rally, what's a good way, I guess, to determine whether it is or it isn't?
Sure.
So go ahead. Sorry.
Well, I think I think the easiest way is just to ask yourself, has anything really changed? You know, has inflation started to come down? I mean, basically, that's the big picture right now is inflation is at 40-year highs. That is causing the Fed to increase interest rates aggressively, and the idea that they're going to have to do that so quickly and increase interest rates so high that it's going to choke off the economy, right? It's going to cause a recession in, you know, if not the later part of this year, then definitely in 2023, and that's going to bring down corporate earnings, and stocks are going to be worth less. That's really the overarching fundamental reason stocks are falling. So you really got to question, okay, you know, has anything in that picture changed? And even if it has changed a little bit, has it changed enough to really turn the market and bring investors back? And obviously, you know, we got the CPI report last week up 8.6% on a year-over-year basis, really turned a couple of months of declining inflation on its head and started going up higher. The Fed increased its interest rate, or its Fed funds rate, by 75 basis points, or 0.75%, which was the highest since 1994, the highest increase. So nothing's really changed, you know. So we see these bounces, these bear market rallies, these traps, like today, like we had in earlier in the year, and nothing's changed. So I find it hard to believe that the market can really continue to build on those gains.
Yeah. So, and speak on that a little bit, because you hear from the Fed and even from Janet Yellen talking about how, rising in interest rates can, the economy can stand that, right? There's a lot of cash as far as savings are concerned, according to them, on the sidelines, which we also know is a lagging indicator. But you have this shift, and I don't think we've ever actually seen this before, where you have rising interest rates, and there's this potential, spending or demand destruction going on at the same time, right? We're seeing housing interest rates go up. We saw housing come down over the last couple of months, purchases of housing come down over the last couple of months, and so those are two different directions, I guess,
Sure.
that we haven't really seen before. There's so much spending going on, but we're also seeing that demand come down as interest rates are continuing to go up. And we're also starting to see from a lot of the big tech companies as well that jobs are also, people are losing their jobs again. We're looking at job cuts. And I think that's probably going to be a trend that continues. And so, how do you think this all shakes out as far as that?
Sure. Well, I think there's a few things you can watch for, right? You brought up jobs. I think that's probably the number one thing to watch for. 3.6% unemployment rate, right around historic lows. The more jobs open than people looking for jobs. So a very strong jobs market. And that's making it harder for the Fed to bring that inflation, right? As long as people have jobs, as long as wages are going up, then people are going to be spending. JP Morgan actually estimates that people have about 6 to 9 months left of extra savings from the pandemic, right? So we've got people with flush cash balances. Deposits at banks are up. They are able to spend. They're ready to spend. So you've got a real counterpoint to the Fed increasing interest rates and trying to slow down the economy. That strong jobs picture and the strong consumer spending is gonna keep inflation a little bit higher, right? Because that's economic growth right there. That consumer spending is 70% of the market.
Yeah.
So once you start seeing unemployment tick up just a little bit, that actually is going to be kind of a case of bad news is good news, right? Bad news for the jobs market could come to be good news for the stock market, because once unemployment gets higher, then people are going to pull back on their consumer spending. Productivity will start slowing down a little bit, or production will start slowing down, and that's going to slow the economy and bring inflation down, right? So I would watch for those monthly jobs reports, the weekly unemployment reports on Thursday. Watch for those to start ticking up. Once you see unemployment tick up to 3.84%, the Fed could start talking about that, and that's what we're looking for, right? We're looking for the Fed to start talking about, okay, you know what, we've been hiking rates, it's starting to have an effect on the economy, so we're going to kind of pause or slow down our rate hikes. Slow down from the 75 basis points down to 50 basis points down to maybe even a quarter of a base or a quarter of a percent increase. You look for that. You look for just the CPI number. That monthly CPI number comes out about the 12th of every month. Start watching for that to come down, just even gradually at first. If we can get that down to 6-7% range, on a year-over-year basis, and then for a core, under 5%, then that would be a really good indication. Basically, the Fed is just watching these, and I know the Fed watches the PCE report, which is a different measure of inflation, but they're very, very, very closely tied together. So you start watching for these. You start watching for inflation to come down just a little bit. You start watching for unemployment to go up a little bit. And I think, it gets to a point where the Fed can say, you know what, we have slowed down the economy. We're seeing signs of that here and here. And so now we can kind of slow down on our rate hikes. That is going to support the market. That is what the market is going to see as positive for eventually the Fed is going to stop raising rates. And we're going to hit those lows, that market low. Yes, we probably will hit a recession, but generally the market tends to bottom out, before a recession or right as it's starting, and then build on the next bull market as we dig ourselves out of the recession.
Yeah, absolutely. It's kind of ironic, right? I mean, the Fed really going even into late last year was talking about the jobs numbers, right, and wanting to bring those jobs numbers down, and not realizing just how tight the labor market was getting. So you almost kind of wonder if the Fed will have a hand in throwing us into a recession, which it seems as if that's probably going to be likely in the 2023. And so with that being said, and by the way, guys, please feel free to ask questions. I'm sure Mr. Hogue here won't have any issues answering some of those as they come along. But let's talk about, the theme of today's show, which is, recession proof or recession resistant stocks. And like, which ones in particular do you think, would be worth taking a look at? Or do you have any individual stocks? Are you more looking at ETFs? And I see Don asking about dividends as well. I think we can get into a little bit of all of those. But yeah, what are your thoughts on that?
Sure. Do you have, can we switch to this other screen or?
Yeah, absolutely. Here you go.
Okay. So if we switch to this screen, this is actual data from, so October 2007 through March 9th through that market low 2009 of the S&P 500 stocks. And you see here, so I've switched it to stocks and sectors. Let's go to sectors first, just to kind of look at that. So we can actually look at sectors, and remember this: the S&P 500 fell 55% over this period, right? So you see a few. You see the sectors of the economy here, and you see consumer staples did the best with 28% down. So again, that idea of recession resistant, not necessarily recession proof, but it did fall about half the amount of the market, right? So you start looking at those consumer staple stocks, and if you ever want to see which stocks are in a sector, you go here to the sector tracker on sectorspider.com. So that's sectorspdr.com. You can go in here to sector tracker, and that shows you all these time periods, the sectors, and then it'll even, if you click on some of these, then it'll show you what stocks in the S&P 500 are in those sectors. So just a really cool kind of way to see, okay, what kind of industries, what kind of stocks are in each sector, if you're looking at that big picture sector kind of idea. So consumer staples, you've got food packaging, tobacco, things like that, things that, we buy whether there's a recession or not. We need Pop-Tarts whether there's a recession or not. You've also got healthcare, utilities, two other kind of recession-resistant stocks. Obviously, with the drug makers, you need to buy your heart medication, whether you've got a job or not. And then utilities, you need the internet to do your internet surfing, whether the stock market is up or down. So you get a kind of an idea that we can look at the individual stocks, and you do start to see kind of a trend. Right. Obviously, Netflix here did the best, 73% up over the period. Obviously, an outlier. Don't go rushing to buy a whole bunch of Netflix thinking you're going to be safe. But you do start to see some of these others in a theme. Okay, so you've got AutoZone was 22% up. You've also got down here, you've got Advanced Auto Parts. You've got O'Reilly. So kind of that idea that as people start to fear for their income and their wages, then maybe they think about fixing up their old car rather than buying new car or used cars or something like that. So you've got those things kind of ideas. You've got a lot of discount stores. You've got Ross stores here. You've got Dollar Tree. So those Dollar Tree stores, you've got some of those discount stores. People might not have money to shop at Macy's when a recession hits, but they can shop at the dollar store. You've got things like that. You've got another big theme here is the drug makers, right? So Baxter Internationals, Gilead Sciences. You've got all those drug makers. I think Pfizer is a little bit lower down on that list. So obviously, again, you're going to need to buy your pharmaceuticals, your heart medication, whether you have a job or not.
Yeah.
So I think that's a kind of an important idea, not necessarily the individual stocks themselves, but that those themes in that. In that the drug makers, pharmaceuticals, maybe even discount stores, auto parts, things like that should be a little bit more recession resistant than others.
On that list too, I mean, I don't see here, but I was looking at over the last couple of weeks, Brown-Forman as well. I'm an avid cigar smoker, and so I was talking to one of my friends who owns a cigar shop, and he was like, I was like, how worried are you seeing any kind of slowdown as far as like demand's concerned? He's like, we're as busy as we've ever been. And he said, really, since the pandemic, we haven't slowed down at all. And he kind of equated, hard times to and vices, right? Like people, even under, in a depression or recession, people still lean on their vices. And so Brown-Forman might actually be an interesting one to look at as well.
Definitely. We see there it was down. It's down 44% in the last one. Now, of course, there's always a caveat to looking back at data, right?
Yeah.
The housing related stocks were obviously hit hard. The financials were hit hard in the last recession. That might not be the case this recession. So you kind of have to temper the data, the historical data, with the a little bit of intuitive reasoning. Also, I am a Jack Daniels man through and through. So I am always going to be buying Brown-Forman products there.
Right.
So I think they should do well. But yeah, it's a great point. You've got your sin stocks, so to speak, your tobacco, your the things that people are just, they're gonna buy whether they want to or not. You've also got an idea of really, and if we can we'll go back to I'll click off of this screen. But you've also got a sense of kind of balancing stocks, right? You look at stocks that are being driven, or whole themes that are being driven by factors kind of outside the rest of the market. One great example right now, I think, is energy stocks, right? Energy is, $110 a barrel per energy. Was, actually down 17% last week, up 5% today. So a strong bounce back today. But really the main factor in energy prices right now is the Ukraine conflict, right? The Russian invasion of Ukraine holding prices up because it's keeping Russian oil off of the market. And for as long as that stands, oil is going to be high, right? So you've got the fact that you've got energy stocks being driven by a factor that is completely separate from inflation, from interest rates, from things like that, right? So as long as the Ukraine conflict goes without a resolution, oil is going to be high. Energy stocks are going to do well, and I think. So if you have exposure to energy stocks, you've got kind of a balancing position in your portfolio, because those are going to do well as long as energy prices are high and you've got inflation. If we do get some kind of resolution and energy prices do come down, well, then the rest of your portfolio is probably going to rebound, right? If energy prices come down, which is a big driver of inflation, then you're going to see inflation numbers come down. You're going to see the rest of the market do really well, right? So I think you've got kind of a balancing position if you've got energy stocks in your portfolio. Another thing to think about with energy stocks, a lot of these companies, I'm thinking Chevron, I'm thinking Devon Energy, Diamondback Energy. A lot of these big oil producers are sitting on cost of production of around $30 and $40 a barrel. Yeah. Right. So even if oil prices come down to $70, $80 a barrel, where they were before the conflict, then you still got cash flow machines in these. I think Diamondback Energy was up big today because the board of directors approved a cash distribution policy of 75% of free cash flow. Right. They increased their cash distribution to pay out 75% of free cash flow to investors through that dividend, through the share buyback program. And that's really what we're seeing, and what we've seen from those energy producers over the last year. Really, they are taking advantage of these higher oil prices to send more money back to investors, rather than just pump more oil out of the ground. Right? They're looking at that long-term picture. They're looking at demand destruction for fossil fuels. And they're saying, you know what, we're not going to spend the tens of billions of dollars to find more oil that we used to in the past. We're just going to return that money to investors. So as long as these are cash flow machines with those higher oil prices, you're going to collect some great dividends, and you're going to have that balance on your portfolio, I think.
Yeah, I think so too. I mean, the one thing that I'll say about the conflict, as far as that's concerned, I think that we for sure will see some sort of pullback, right? If somehow that ends, but I don't
Sure,
think
you've
it
got to.
necessarily solves the shortage issue too. So I think that it could almost be a dip opportunity there, because the sanctions just aren't going to fall off as soon as the conflict is over, right? People are going to continue to hate Russia and probably fail to do business with Russia, especially if they figure out between now and when they pull out how to get their oil somewhere else, and not really want to do business with Russia anymore. So I think that there's definitely a case to be made, so to speak, that even if the conflict ends, doesn't mean necessarily that the shortage of oil won't continue to be a problem. And to your point, as far as how much the energy companies are making, for as it relates to the cost per barrel. I was looking at Marathon Oil, for example. That's a popular one that we look at here. That's trading at 5 times next year's earnings, and they make their break evens at $35 a barrel. So they're just making an absolute killing.
Yeah.
And so it just we saw a pretty decent correction, I guess, maybe because Biden was in Saudi Arabia. It just created a lot of selling off here, and this chart looks very similar to some of the other energy stocks. But I'm in the same camp you're in, man. I just think that that even with that an ending of a conflict in Russia, it may not actually solve the issue as far as shortage is concerned with oil.
No, it won't. I mean, just look at where prices were before February.
Yeah,
I mean,
they
they were
all
still
going
at
up.
they were still at 75, 80, $85 a barrel. So yeah, I think that's actually an interesting strategy. If we do get some kind of rumors or resolution to that, yeah, you will see oil dip quite a bit. But I think it will be an overreaction, because
Yeah.
even with a mild recession, you're still going to see a strong demand for oil products, and the supply just isn't there. We haven't been building out the supply. So yeah, I think it would be a dip opportunity there.
Yeah, absolutely. And there's some calls for natural gas to go to $20, which would be crazy. But if nothing changes, and we get into the winter months, and Russia decides to cut some energy lines, I think it's very possible that it could get that high.
Yeah.
Pretty scary stuff. All right.
So yeah, you've got an idea of recession resistant stocks and
Yeah.
things, balancing parts of your portfolio, and then kind of to go out to a little bit more recession proof. You really got to go to some of the other assets, right? You've got to go to savings bonds, right? The I bonds, really popular right now, offering 9.6% yield, right, on a savings bond, a guaranteed savings bond kind of investment. So that is unheard of. Those are the kinds of things: commodities, real estate, things those real assets that are going to be, going to benefit, or at least going to support their value in inflation, things like that. As well as, I mean, it doesn't sound sexy, but money market funds are now paying 0.6%, whereas just 5 months ago they were paying something like 0.02%. So even safe money market funds have done really well with this, with interest rates increasing. But yeah, to get into that recession proof theory, you really have to move outside of stocks into other asset classes.
What do you think about? I mean, I don't know how much you speak on cryptocurrency or anything like that, but what are your thoughts on Bitcoin and how that's been trading lately? And you hear all the time that it's an inflation hedge, right? And obviously inflation's been going up, but it's been doing nothing but going down.
Yeah.
So do you have any thoughts on that? Do you mess around with that at all?
Sure. Oh no, I've got quite a bit in crypto, Bitcoin, Ethereum's principally. I also own some Polygon, as well as some of the other coins. But I mean, I think investors are still a little confused as far as what crypto is, and as an investment. Sure. Is there a limited supply of Bitcoin? Is it, can it be an inflation hedge? Yes. Can it be a gold, digital gold, and an alternative to gold? Yes, it can be. But right now, that is not what it is. Okay. It is, as a new asset class, it is just a growth risk, high risk, high return type of asset. Someday it will be more of an inflation hedge. Someday it will be more of an alternative to gold and fulfill a lot of those roles. But right now, I think if people are looking to it as something like an inflation hedge, they're going to be disappointed, right? Because obviously, as we've seen, inflation is way up, and cryptocurrency prices have just crashed, have just crumbled. That's not a reason to not own it, to not sell it. It's just you just have to have that correct perception of what it actually is right now in its life cycle. Cryptocurrency is very much like the internet was in 1994, right, when we were all still on dial-up and dialing into AOL and hearing the screeching sounds, right? If most people probably don't even know that reference, but yeah, there was a point. So it's just a very much a different asset from what it could be or what it will be in the future. Now, that's not to say that Bitcoin doesn't have real intrinsic value. And I think that's what we're getting down to right now. Bitcoin and Ethereum especially have real utilitarian value as their need to verify changes in their blockchains. Right, the blockchain technology is being used in many industries, especially records management, healthcare, really changing a lot of ways we do things in a lot of these industries. And of course, to make those changes on that blockchain, then you need cryptocurrencies to verify, to either for the miners to verify or as a proof of stake model. So they do have utilitarian value. A lot of the, what did Peter Thiel call them? The financial geriatrics, right? That don't understand or haven't taken the time to actually understand what cryptocurrency is and what it's about. Don't really see that. They don't understand the real utilitarian and intrinsic value in these. Now, that said, I will say that a lot of the poo coins, right, don't necessarily have that value. They don't have that utilitarian need. So I don't personally invest in those, but definitely Bitcoin and Ethereum, they're not going away.
No, they're not. And I think it's also important to think about this too. You look at, this is a monthly chart of Bitcoin, right? The crashes, while extreme, you're still seeing higher lows with each crash. So, and this goes all the way back to, when it went up to 3,000 and then crashed all the way back to 1,500. And we just saw just this past year. I mean, it went all the way up to 64,000 and then came all the way back down to 28. With the exception of this recent crash, where it went all the way up to 69 and came down to 17.5, we go back in 2017, the dollar amount is still higher than what it was in the previous crash. So when we saw it in 2017, when it came all the way up to like 19,800 and then came back down to 38, it still never retreated back to those lows that we saw in 2017. And I think that's also worth noting as well. A lot of people who might have bought it up in the $60,000 range are probably feeling it right now. But if you still held on to it back in 2017 or even earlier, you're still sitting pretty. And the average return on Bitcoin since its inception is 200%. But it doesn't mean that there isn't volatility in between.
Yeah, there's no denying that as an investment, especially a longer term investment. I mean, Bitcoin, even Ethereum over the last few years has just been an amazing investment. And now is that opportunity. Investors love to get excited, love to get enthusiastic about buying stocks and crypto and any new asset when those stock prices are going up and when, everybody, including your Uber driver, is telling you about it. But then they freak out. They panic when prices come down and actually present them with opportunities. As soon as we get, so Fidelity has already said they're going to start allowing 401k customers to invest through their 401k in cryptocurrencies and Bitcoin. That's going to be a huge driver to the market. The SEC is eventually going to have to approve a spot Bitcoin ETF. Right. They've got, I think, I want to say about a July 7th deadline to approve or deny the GBTC transition. If they don't approve it, then they will be getting sued. The company has already said that they're going to probably open up a lawsuit against the SEC for not approving that. There's multiple precedences to open that lawsuit and to force an approval almost. So there are a lot of catalysts. Even the next halving cycle, which is just a couple years away. There are a lot of catalysts to send Bitcoin and send cryptocurrencies back into back higher and into the next bull market.
Yeah.
So I think this is the opportunity to dollar cost average down, or to even start investing.
Yeah, I agree. I think those are all some excellent points as far as that's concerned. Let's go ahead and get some questions here. I see Jeff Chow chiming on the AOL comment, says, but the real one had net zero.
Yep.
Oh man, I just got done talking to Ali about MySpace. It's like, man, remember we were like makeshift coders back then. A lot of
Yes.
copy and pasting.
It's amazing how things have dropped by the wayside, like net zero and AOL internet, and just been replaced. Yeah.
I mean, every day from when I came home from school, I was on AIM. I was on AOL Instant Messenger. So Don was asking one from the beginning of the show. Says, if we were to enter another lost decade, I think you're probably referring to what we saw between the .com bubble and I guess up into the 2008 recession. What dividend stocks would you want, or what strategies would you use?
Okay, sure. And yeah, what he's talking about here is a secular bear market. And we do see those. We see those 10 to 15-year periods where stocks basically go nowhere.
Yeah.
That the best example, the most recent example, I guess, was after the .com crash, 1999 through 2000, and I think even 2013, 2014, where over that whole period, stocks really went nowhere. Now you can still make money in those if you because they are cyclical highs and lows in there. So you can still invest in there, and by investing regularly, you still make decent money. But it is possibility. It's not what I'm expecting right now, just because we have too many technological advances really driving economic growth and driving the secular market in the secular bull market. But if we were to have something like that, I would definitely look to some inflation resistant kind of stuff, because I think inflation is really going to be the driver to that secular bear market. So even outside of investments, I'd say don't be afraid of debt. With mortgage prices up at 6% right now, if inflation even slows down to, let's say, 5%, then you're only paying 1%. After inflation on that debt. So debt can be used. You got those inflation resistant or inflation proof kind of ideas like real estate. I would stay, even bonds to a point. I think, the Fed probably raises its federal funds rate up to 3.5% or 4%. At that point, they're going to kind of pause, slow down at least, and especially if we start to see the economy cracking a little bit, that's when you can start getting back into bonds. You can start making a really good, 5, 6, 7% annualized in bonds, and fairly safe bonds. And kind of protect yourself from the stock market weakness a little bit more. So I would be looking at that. As far as dividend stocks, again, those consumer staples that we have to buy, those are going to have a little bit safer cash flows. So consumer staples, things like Kellogg, which announced a big strategic decision today to break up into three companies. You've got things like that. You've also got within that consumer staples, I think what we saw over the last year, they really underperformed because those companies, they were on the forefront of the inflation. Okay. They were seeing all of their prices for grains and commodities go up. People weren't expecting inflation yet. So they weren't, the companies were really worried about passing on those costs through higher prices. So they weren't raising their prices. Profitability really tumbled in consumer staples companies over the last year, and their stock prices suffered. Now I think we're getting into the point where investor or consumers are they know inflation is coming. They're more accepting of those price increases in different products, and especially these consumer staples companies, they're more able to pass on those costs, and the profitability is increasing back a little bit higher again. So definitely consumer staples. The real assets like real estate, maybe even some commodities. I think you can hide out in those.
Good stuff. Next question from Pixie. Is there in this kind of environment any kind of like tech stocks that you could still kind of lean on during recessionary times? And I'll give my thoughts on this real quick. I think I don't think you can go wrong with Apple at any point in time. I think that's just a stock that you don't necessarily trade. You always just want to own it, in my opinion. That's a stock that I would say that you could regularly add to and feel comfortable with owning. One good thing that I noticed today, a research piece came out from USB UBS about supply chains easing in China, and that they're actually selling more iPhones than anticipated, which is a good sign. We're seeing that come down. So I think that there's still going to be some good tech stocks, even with a low multiple as well. Like a Qualcomm, for example, I think is a good solid tech stock that, while still more than likely could see some volatility, the multiple is just so low that I feel like you can't go wrong with stuff like that. What are your thoughts?
Yeah, actually, I think tech is getting to a point where it's really attractive, especially the growth stocks that we saw a year ago, which at just ridiculous valuations, right?
Yeah.
Some of those tech stocks, they are still, people are looking at them, and one of the biggest mistakes investors make, I think, is they look at a stock chart, they see a stock has come down, a stock price has come down, and they automatically assume it's a bad investment, right? So a lot of these growth stocks that are still posting 20 or 30% annual sales growth and are leaders in their industry, really leaders in a growth industry, are still great companies. They're still growth companies, but not necessarily growth stocks. I think you've got some real opportunities in picking up what could be, the next Amazon, the next Apple over the next 10 years. So I'm really looking at a lot of these stocks that are down 75, 80, 85%. So I'm looking at those. It's hard to go wrong with really that size and the scale in a lot of the tech stocks. I'm thinking, like Apple, like Amazon. I had to look up to see remember who it was, but Dan Loeb over at Third Point really did some analysis on Amazon a couple months ago and said he believed, the valuation on Amazon could be almost, as much as double of where it was if they did some kind of a breakup between their cloud services division and the e-commerce side, right? So a lot of unlocked value there with Amazon and Google, particularly. I see a lot of that kind of lottery ticket upside, right? Basically, the stocks are priced for those core parts of the business. With Amazon, you've got cloud and you've got e-commerce. With Google, you've got Google or Alphabet. Obviously, you've got Google. So search, you've got YouTube, things like that. But what these companies have is a huge venture capital arm where they're investing in new technologies and new companies. And basically, so good example with Google is their Waymo division, their self-driving division with Waymo. If that hits or when that hits, I mean, that is a big upside to these stocks. And I think you get both of those with Google and Amazon. So you're basically paying for, a fair value estimate of the core business and getting that lottery ticket upside with these other stocks or with these other investments.
Yeah, man. I mean, you look at YouTube, and if it was a publicly traded company by itself, it would be bigger than Netflix, which is just mind blowing to think about. And I'm looking at a couple of other ones too. Facebook, or Meta Platforms now, that's trading at 14 times next year's earnings, which is still just ridiculously cheap on a company that's bringing in $40 billion in free cash flow. Which, I mean, at some point, people are just going to look at this and think that it's ridiculously priced.
Yeah. People love to hate on Facebook, but how many times have you logged into Facebook today? I know I don't even like Facebook. Okay, if it wasn't for my business, I probably would try not to be on Facebook, but I'd still be there anyway. And I've been there probably 6 times today. The social media stocks have been slammed this year on those changes in the Apple privacy policy, as well as lower ad spending. But they will, Facebook, and especially with Facebook, you get no other social media stock has that kind of scale or scope as Facebook. Okay, the other social media stocks, Snap, Pinterest, Twitter, even, you've got one site, right? With Facebook, you're getting the WhatsApp Messenger, you're getting Facebook, you're getting Instagram. So you're getting a real scale of social media sites with that. So I think, Facebook is another great example.
And then I was looking at PayPal as well. That's trading below trading below pandemic lows now at 18 times. So it's just crazy to see some of the stuff that's down. So safe-ish Pixie, probably safe-ish, but definitely at a pretty decent value. Even if they do go lower, it's still ridiculous.
Yeah, if you can, I think a lot of investors, especially new investors, we've been spoiled over the last 12 years to think that stocks only go up, right? And stocks provide that, that 1 year quick win. Okay. people are used to and expecting stocks to make money every single year, and that just doesn't happen. If you can, I think I saw New York Stock Exchange data shows that the average holding period for stocks is now 5.5 months. Less than half a year. So I think a lot of investors, they're buying stocks, expecting them to be up over the next month, over the next 6 months. And when they're not, they're disappointed, they're disillusioned, and they sell out of those. You've got to hold these stocks. If you can hold your stocks for 5-10 years, there are some huge opportunities right now. I also, I love PayPal as well. A lot of these stocks, these growth stocks that we were talking about a year ago, these are changing the world in which we live, and one of them will be a huge, the next 10 or 15 or 20 times your investment from here.
Yeah, I agree. I agree. This is a good one from Jeff Panicka asking, do you think the economic effect in 2007 to 2009 had less impact to what we were facing today, and the economical and political impacts that we're experiencing?
Ooh, okay. So politically, that's a whole nother story. I think that the political environment right now is so charged that we are on the extremes of everything, right?
Yeah.
So, and I'm not a political scientist. I love reading stuff just for my own morbid curiosity, but that's another story. But as far as the economic effects, I think they were much worse in 2007, 2009. We saw amazing amounts of debt, household debt, in 2009 that was just going to, it was inevitable that was going to break the system. We saw, 100-year-old banks, 100-year-old banks with a huge storage history, just evaporate, gone overnight, right? So a real threat to the system, and to the system of capital markets. I was only a few years off of working in venture capital at that point. So I still knew a lot of friends in investment banking and capital markets and things like that. And it was just amazing, the speed and the loss that we saw during that recession. Right now, I think, I'm still in the camp that it's going to be a fairly mild recession, right? I'm definitely thinking we're going to hit a recession next year. It'll be probably longer than most recessions, but not quite as deep. Okay, because the Fed is fighting inflation at 40-year highs. It's going to last for longer. It's going to be harder to bring down, but we still see. Okay, like I said, J.P. Morgan estimating that consumers still have 6 to 9 months of excess savings to work off. Upwards of $10 trillion in savings accounts still from the pandemic. Corporations are still sitting on decade highs for balance sheet strength. They really took advantage over the last few years of those lower interest rates to really load up on their on the debt that they had, and so those rates are locked in. They have very good balance sheets and very high cash amounts. So a very strong environment, really. So I don't think everything is going to fall apart. It's just going to be a long, hard slog to bring inflation down and bring everything back down.
Yeah, I think that at least millennials, people my age, and maybe even younger or slightly older, and you could probably attest to this as well. When you hear the word recession, automatically you're thinking about the GFC, right? Like you're thinking about worst case scenario, everything just crashes. But not all recessions are the same, and I'm in your camp as well. I think that this recession, just because it is one, doesn't necessarily mean it has to be a repeat of what we saw in 2008, 2009. I think it's just going to be more or less of a slowdown, and not necessarily just this all-out depression-like atmosphere or feeling. It's just not gonna feel as good as the times that we were in probably for the last decade.
Yeah. Oh yeah, it won't be as we won't have a bull market like we were in the last decade for. I don't know when we'll see that, because really we saw so much money pushed into the economy after the great financial crisis, and then even into the pandemic, as well as the tax reform that really lowered tax rates for corporations and really pushed a lot of pushed those earnings up. But yeah, that financial crisis in 2007. It is just amazing how frozen the capital markets and really all of capitalism was for upwards of a year. I had investment banking friends still working in the industry that they couldn't get a deal done for like 4 or 5 months straight. They're basically just out drinking all day because
Right.
there was just, the capital markets were just frozen. Everything was a standstill shock, and it was rough.
Yeah, it just I don't know if we. And what's crazy is that the financial markets didn't actually recover fully until just last year,
Yeah.
January. January, we saw the XLF get back finally to levels that we saw that were back in 2008.
Yeah. Well, look at the bank stocks. I mean, look at Citigroup. I
Yeah,
mean, that stock, if you look at that 20-year chart, I mean, it's still showing like it was Armageddon
right.
back then. I mean, of course, if you bought after the crash, then you've done very well. But over that long period, I mean, the financials just got hammered.
Yeah, it was just crazy, and the recovery just took forever. Um, uh, a Google interview as
Sure.
asked, is holding cash a good strategy now? I'm not buying, trading anything, and wondering how to manage the cash I have. It's obviously an interesting question because we're seeing, that cash depreciate in value. I mean, we're continuing to see inflation numbers at 8+%. So that's certainly a risk just holding cash. So it's a great question. I think that investing in something is probably better than sitting in cash. Obviously, diversifying. We talk about that a lot. What are your thoughts on
Sure. Well, I don't think you have to worry too much about inflation on your cash, right? I mean, cash is obviously going to give you that maximum flexibility with what you can do with it, and even if you're sitting on something for a year, that's only 8% loss.
Right.
If you're sitting on it for a year, which means all these other factors and everything hasn't turned around, then stocks have probably done pretty badly. Stocks have probably fallen apart if we're still talking about the same thing in a year,
Yeah.
and you'd only be down, 8% in cash. Now, I would say, I mean, there's other cash-like investments, those I savings bonds do lock your money up for a year, but that's 10% return on those. Some of the other, investments that we've talked about, other asset classes, but I think, I think you can hold cash. I've actually got about 20% of my own portfolio in cash, really waiting for different markers on the S&P 500, waiting for legs lower. And I think an important strategy here is just to formalize what you're going to do. I see too many investors just rush to their market screens every day, stressing over, okay, is this the low? When do I buy in? Should I buy in now? And of course, they get impatient, they get frustrated and stressed out, and they just push everything all in, and the market still has further to go down. So I think putting markers on when you're going to invest some of that cash and doing it in a staged process, right? So I'm waiting for about 3,500 on the S&P 500, 3,400. That would be about 27-28% down from the peak, kind of an average stock market crash kind of thing. I'll invest maybe a third of my cash at that point. If it keeps on falling, 3,100, maybe 3,000, then which I think would be about 40%, 37%, 38% from the peak. I'll do another 3%, and then if it falls further to 2,800, somewhere around there, 2,700, something like that, then I would go all in with the rest of my cash, right? And at that point, I'd be fully invested. Maybe if it keeps falling further from there, you consider starting maybe a little bit of margin, that long term idea. But really, what this does is, besides taking the stress out of that market timing and that guesswork, and just pulling your hair out, so it also puts money to work at different stages. So, right. So if we hit 3,400, I put in a third of my cash. And if we do get a bounce back from there, into a new bull market, I've got money invested, right? I can benefit from that. If it does keep on falling, I've still got cash set aside that I can reinvest later on. So it kind of gives you the best of both worlds, not trying to time the market all the time, but putting some back to work and keeping some behind. And more importantly, I think, again, it just takes the stress out and that guesswork out of when to invest.
Yeah, I love that. I love that. Great answer. Last question here. It was Don was asking about Tesla. He said wanted to hear your opinion on owning Tesla. Obviously, there's a lot of creators out there on YouTube that you have almost like cult like following. Do you have any thoughts on that in general? I mean, obviously trading at a ridiculously high multiple, but the growth is certainly there. So maybe it's worth paying a premium on. What do you think?
Yeah, Tesla is tough because Tesla is kind of like Amazon in the respect that I've always said, I just can't bring myself. I'm a value investor at heart, right? So it's always very difficult to invest in something like an Amazon that is trading at these much higher valuations. But it always surprises. It always does surprise higher. So Tesla, I think, has a lot of that. Tesla does have that cult following, and I think there's a lot of that and for lack of a better word, I guess cult premium around Elon Musk, that people just are going to invest in him and his company. That's obviously kind of a risk as well. If that cult personality comes off a little bit, as we started seeing with people questioning his move with Twitter and that kind of thing, then some of the shine has come off of that. So you've got to watch out for that. But I think at this point, obviously after the crash and after shares have come down, then I think people that believe in the company and people that believe in the future of the company can invest. I think you've got to consider a big part of the valuation in Tesla right now is not only electric vehicles, but also that idea of a ride-sharing self-driving taxi. Okay. In fact, if you look at like ARK Invest forecasts, then their bull case of like $4,000 per share on Tesla, about half of that is predicated on about a third of their revenue being from self-driving ride-sharing taxis by 2025. Right. So, it really depends on how quickly they can capitalize on that market, how quickly they can get that technology to the market and start using those. And I'm really not, I'm not optimistic on how quickly we get that self-driving ride-sharing kind of idea. It is being tested and is being rolled out, actually, especially in Arizona and some of the western states. But I think it's a while before they start really driving key revenues from that. I think it's obviously we've seen the promises for self-driving vehicles and self-driving automated vehicles for years, and they continuously miss those markers, those timelines. So I think it's, along with pretty much everything else in tech, it's starting to look like a good valuation, attractive valuation. But I would kind of temper my optimism on some of those high targets that you see, just because I think self-driving is further out than what a lot of people would like to believe.
Well, yeah, and you look at that Waymo, for example, we talked about that earlier, and competition's already coming for them as far as that's concerned.
Mm-hmm.
And
Sure.
the thing with Waymo is that it's not just with EVs. You can have a robo taxi with any vehicle, an ICE vehicle, EV, it doesn't matter. It's the software that they put in their vehicles. It's not specific to any one type of car. They can put Waymo on just about anything. So that's definitely going to be something that I think that if you're a Tesla bull and that's kind of something that you're resting your laurels on, you have to really consider that. I always tell people all the time, it's like, if you are super bullish on something, find the stuff that makes it bearish and then determine whether or not you like it. Because if you're just looking at all the good stuff, then you're gonna just basically you're buying stuff blindly and not really looking at it objectively and trying to figure out, okay, what are the weaknesses here and can I live with that and still invest in it? And if you can't, obviously you know the answer to that, but and what have you. But yeah, I always try to poke holes and stuff, even in some of my favorite stocks. I always try to find some sort of weakness that could bring it down and determine whether or not I still feel comfortable parking my money with them.
Yeah, great strategy. Yeah.
Good stuff, man. I appreciate you coming on. This is a lot of fun. And I would love to have you back on at some point. But if you wouldn't mind letting everybody know how they can find you and what you got going on.
Sure. Yeah. I'd love to see everybody come join the community on Let's Talk Money. They're over on YouTube. Links in the description there. Yeah, just love that face-to-face connection we get here on YouTube. If you want to read, then I've got a blog, mystockmarketbasics.com. It's a little bit more basic ideas on stock investing. I do upload my transcripts from the videos on there, but a lot of it is just kind of those basic ideas, how to start investing and really, how to avoid the biggest mistakes. Right. So yeah, check those out. And yeah, it's a great time.
Yeah, both of those links are in the description, and so go check those out. Joe's got a great channel. I personally watch it myself as well to get some information too. So all good things. Joe, again, thanks so much for tuning in, guys. We'll be back here tomorrow. Thanks for coming along. We'll be back here tomorrow at 3:45 p.m. Eastern time. There is a couple of earnings that we can talk about. Some of the home builders are reporting this week, so we'll cover that tomorrow afternoon, and we'll see you guys then. Thanks so much.